Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for the segment, I have Patrick Reily, co-founder of Uplinq Financial Technologies, to discuss how 22-year high interest rates affect small businesses and the economy, inflation, and spending. It's great to see you as always, Patrick. Welcome back to Trade Talks.
Hey, Jill, great to be here. We've been going through these recent rate increases on unprecedented speed, moving forward. And we've never seen anything quite like this before. So it's great to be here with you and get through it.
Yeah, it's great to get your insight as always. So earlier this week, the Fed announced its decision to hike interest rates again, bringing them to a 22-year high. How does this affect small businesses in our economy?
It's a 22-year high. It's also faster than we've ever moved before as well. And so frankly, it's tough for small businesses, particularly younger small businesses, businesses that may have come out of households that didn't necessarily have an opportunity to accumulate a lot of wealth. What a lot of people don't know is that about 84% of small businesses launch on personal ability to borrow. And so that's normally tapping into things like home equity loans, tapping into things like credit cards. Credit card rates have actually risen faster than Fed funds. And home equity loans, you've got this compression on property values. At the same time, you've got a situation where rates are going up. So it's hard.
Apart from raising interest rates, is there a more effective measure the Fed can implement to help curb inflation and regulate spending?
Boy, that's a super important question. So, we got into this problem by the government spending more money than they had. And so working to a budget is the best way we can get through this. Now, something that a lot of people may not know as well is that the Fed can basically print money and so on. We've all heard that story before, but they also buy and sell securities. And for many, many years, they held about $4 trillion in securities. And starting in April 2020, they actually began buying securities. Think about what that happens. They're taking in securities, they're pushing cash into the marketplace. Well, they just didn't buy a little. They bought about 4.4 trillion in securities. And so one of the ways they can do this is by beginning to sell those back, and that pulls cash out of the market. They've done about 20% of that increase they've done, but if they do that more, that'll definitely be a big plus. So, and these are things that aren't going to hit consumers and small businesses the way interest rate hikes do.
Does the latest interest rate hike further tighten lending conditions of banks throughout the country?
Absolutely. There are a couple of phenomena that are going on. So banks have tightened credit criteria in general. So the best of the best small businesses with the strongest standing are still able to reach, although maybe at higher interest rates in the past. But banks have seen a couple of big things happen. Not only margin compression squeeze, what they pay for money has gone up, while oftentimes the debt that they're holding, if they've got longer term debt, they're going to be in compression. In addition to that, sometimes their collateral values have deteriorated. Think about what's happening in commercial office space and stuff like that, where it's getting tougher to turn that. Well, they've got to take a position about that to protect themselves. And that makes it tougher for everybody. And so, but especially subprime, most of the subprime space in small business is virtually evaporated.
Do you see a correlation between interest rate hikes and small business default rates?
Really do. And maybe you could pull up the slide that kind of speaks to this. But, smart small businesses plan ahead. And they are small fish in a big pond. They don't expect to be in control of everything. And this graph really tells the story. So at the beginning of rate increases, small businesses had provisioned for it. So we're looking at a relationship between Fed fund rates and small business default rates. And what you can see there is for the first half, really about the first 2.5% of Fed funds increases, small businesses were ready for it. They absorbed it. They reacted to it well. It really didn't have an impact. But then as they continued to go up, as they went up above historical levels, now we see a one-to-one relationship, really lockstep, tied together, perfect correlation. So for every 1% in Fed funds increase, we're seeing about a 0.5% increase in small business defaults. So it's a big problem. It's an important problem. It's one that says this is why you just can't turn the interest rate knob to fix a problem like this.
What's your advice to small business owners striving to access working capital today?
Yeah, so my first would say is that if you're trying to, if you're somebody with great credit, your best options are still going to be going to a bank, but it may not be your bank for the same reasons I mentioned earlier, those composition changes that are going on from bank to bank. And look for a bank that sees you more completely beyond just a credit report and your financials, sees you more holistically, uses an advanced approach. That's probably your best chance to get a great rate. Now, not everybody fits into that category. And if you have, less strong credit, if you're just getting started, if you're just moving ahead, I would still suggest you look for traditional credit sources through a bank, but you probably also need to be thinking about things like friends, family, community sorts of places to pull and maybe get a little bit of help.
So speaking of rate hikes, will this be the last one of the cycle?
You know what? I think it will be. And, we can help make that happen if we all get on the phone and call up our Congress and our senators and say, hey, I got to live in a budget. You live in a budget. Let's make this work. I think the other thing is, if the Fed continues on its trend or maybe accelerates its trend to drive down that additional 4.4 trillion I talked about, that'll also have a really positive effect on things and get us over the hump.
All right. And finally, Pat, anything else you'd like to share with us?
Well, for everybody out there, hang in there, watch your checkbook, and better economic times, I think, are around the corner.
All
So
right.
thanks for having me, Jill.
You got it. Appreciate the insight as always. Thanks for joining us. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Take care. Bye-bye.